So today we're going to have a great discussion about something new that we have been working on the last couple years to introduce, I think, some very good egalitarian investment initiatives for the vast majority of people that have been kind of boxed out of the wealth industry, and then just understanding a little bit of the history of why it is how it is, so that you kind of get that perspective. So let me go ahead and get the presentation booted up for you here. And bear with me. We're gonna go with the window right there. Okay, so hopefully you can see my screen now. So we're going to talk about our Planck Portfolios. We named it as such because Planck, the Planck constant, is kind of a famous. You can't see what? You can't see. No. Okay. All right. So the Planck constant, as I was starting to say, is a famous physics terminology for one of the smallest forces in physics. And there is a industry thing that has come along the last couple of years called direct indexing. And we wanted to make a more inclusive version of that includes being able to customize the investment strategies, not just being indexing, but being able to break it down so we can do this for some of our smallest portfolios and investors, so that we could bring awesome investment management that's been reserved for a small elite, hopefully for the rest of us that are starting off saving up from the beginning, or starting late, or whatever the case, or maybe our investments are just broken into multiple different accounts, which happens a lot now with IRAs and Roth IRAs and individual accounts and joint accounts and your kids' college savings plans. The money gets split into lots of different things. And so it's not getting that economy of scale as much as it used to back in the day with people just kind of having one investment account. So as always, we are an investment advisor. We do give our clients investment advice and tell them what to do. But whenever you're watching something like this, it is for informational and educational purposes only. We try to make sure that we do our due diligence and look at things, but we do not guarantee that any of the information or warranty that is totally right. You should double check everything inside of here. If you want individual advice from us, come be a client. We'd be happy to do that. Get you, depending on what level you choose to hire us at, hooked up with a coach or a financial advisor, so that we can do that for you on an individualized basis. So if we're not that person for you, consult your personal financial advisor, attorney, CPA, etc., before taking any actions. Okay. So what we're covering today, we're going to talk about traditional portfolio approaches and how things have been done in the past. Again, take some of the stuff. I create tons of presentations. I'm probably doing about 100 or so per year, and they're all customized, and I make them for each presentation. So I have to get my economy of scale. So I use some AI imagery and different things like that. So it's not always perfect. But personally, I kind of like the quirkiness. So we're going to talk about the traditional portfolio approaches and how the wealth management industry and financial advisors have approached it, as well as how most people are kind of DIYing and what kind of comes from that versus how the advisors are doing it. And then some of the things that in the last couple of years, 10 to fraction of a year, have started to really come along that's enabling some of these things that we're going to talk about today. And then we're going to drill down into what we're doing specifically with these Planck portfolios that hopefully you find as interesting and exciting as we do. Okay. So when we look at the traditional way of building portfolios and the things that you've read about in history or some of the articles in the Wall Street Journal, it really was reserved for the top % of a percent. And you'll still see most financial advisory firms, the good ones out there that have high touch, the advisors or the people that serve you have a lot of experience, or there's a diverse team that serves you. They have generally pretty high minimums. At a minimum, most firms will say you got to have $250,000 in accounts with us that we charge a percent type fee from, or you can't even be a client. That's moved up, I would say, now to above 500,000. And then for some of the things that we're going to talk about where they build customized portfolios, not kind of cookie cutter model type things, I mean, it's $1 million plus, because they're just not going to put that much expertise, which is expensive, and specialist time building things that are customized for people when they are not reaching a certain economy of scale, right? And so if you think about $1 million, the average advisor charges a percent, that's about $10,000 per year. And so you can see if you try to do that for $250,000, be $2,500, which absolutely is a lot of money for most people based on what they make. But when you talk about you got to pay multiple professionals, overhead, some of these people that work for you are actually expensive professionals. That's not going to cut it, right? They're just not going to really be able to make an adequate profit margin. And that's why you get these high minimums and people don't get access to these things. And so private wealth management, right? And then beyond that, until recently, there were high trading costs. And so if you wanted to buy into most mutual funds 10 plus years ago, you either had to pay sales charges or you got it locked into something that was a higher internal expense and a penalty if you tried to get out earlier. Then more of those more commission-free mutual funds started to come along, and then most of the brokerages would charge you, $10 to $50 per trade. So if you had too many funds or you traded them too much, especially if the account was smaller, then that ended up being expensive just to be able to buy and sell these things inside of there as well. And then the same thing for stocks, and then later on as ETFs have gotten more popular, those trading costs. More recently, the trading costs have gone down a lot, and you've heard all the stuff from all the different broker dealers and custodians where it's like, you can trade, for free, commission free, when you buy stocks and ETFs. They still make money based on how you trade and the spreads in between the buys and the sells and trade and sending order flows out to. So they just made it way complicated and less transparent. So now it's very difficult to even know what the trading costs are for most people, especially if they're unaware that this is even going on and they're just throwing their trades out to the market without any qualifiers. So again, this is not a trading webinar. I have done some of those. But for this one, we're going to concentrate on what we're talking about here. And then, of course, paperwork and things are complex now with all these different custodians. And even though they tried to make it easier with DocuSign and electronic signatures, it's still a pain. I see a lot of the more progressive ones doing a better job. Like when you look at even like some of the crypto exchanges and Robinhood. One of like our new ones that we like, Altruist, where it's like an electronic, very fast, open the accounts, link your, funding account via Plaid, and you're ready to go in just a few minutes. But still, a lot of the institutional traditional portfolio is still kind of on the old school stuff of the complex process and paperwork and admin barriers and transfer fees, trading fees, or the lack of transparency into it. And so again, you're not going to find a lot of financial planning investment firms that have the high touch service and experienced advisors wanting to do this for smaller accounts. Okay. So again, I'm not defending them. I've been on a mission since I started this company almost 14 years ago of saying we're going downstream, we're going to build things and do things without minimums to give better investment opportunities, better financial planning outcomes to people that need it the most, that can't get access to it and get boxed out by this two-tiered system, which, in our, very profit-centric economy, just hasn't evolved because people are like, we can't make enough money. We can't make a high enough profit margin off this. We're just not going to serve those people or create these services. So anyways, I'm just helping you understand. We start getting to the other side of things to say, all right, I can't get them, but I can do it myself, right? And so that's the DIY. Most people know that do-it-yourself portfolios. And without the professional guidance, though, when you self-direct, that's another way of saying it, self-direct your investments and strategy, there are lots of challenges. And for most people, until something really bad happens, they don't even recognize that these things are happening. Okay. So I'm going to go over just the more, easy way of saying it. And then I'm going to go over some of these behavioral heuristics and fallacies and what so that we all fall victim to. And it's interesting. There's hundreds of them, but these are probably some of the biggest ones on the investment side of things. So anyways, when we look at some of these challenges, we can't help it. We're emotional by design. It helps us make decisions instead of being stuck in deciding which alternative to take forever. It makes our life worth living, right? If we were just logical and didn't have fun or fall in love or do anything cool, what's the point of living, right? So we are very emotional, and there's not necessarily anything wrong with it. It just doesn't help us very well most of the time making investment and financial decisions. Most people end up with limited diversification. So they end up investing in things from things that they've heard about or that have done well for them in the past, or their parents, or people that they respect, or some reading material from whom the author or the organization they really respect. And so they don't end up with a lot of different things. You may have heard, if you try to make yourself better at investing, putting your eggs in different baskets, so that, if one goes bad or what, so you're not sunk. You've got all these other ones in there that hopefully are still good. But a lot of people end up very limited in that area. And then, of course, because we're collecting these things and, maybe getting auto enrolled in your 401k at work, and you set up that Robinhood account because of some Instagram ad, and you bought, a couple stocks that were popular, and you really like Tesla, you really have no strategy. There really isn't a strategy besides you bought things that you like, or you stumbled upon, or you were forced into some way or another. And then, of course, beyond that, you're probably, if you're successful at investing, going to be investing for a long time, because that's when you get the higher probabilities. Like there's a greater chance that you're actually going to make money, and that the percent that you grow on the percent and the percent year after year after year really starts to exponentially accumulate for you. Well, if you don't monitor that, and there's no strategy or limited diversification, you could do really well for a certain period of time and get really concentrated into something that, if that goes bad later on, really sinks your ship. And so you should be monitoring to make sure that you stay on strategy and that it adapts when you change throughout your lifetime. So these things happen almost all the time. Okay. And then it's just different for different people at different points in their life. These are some of those behavioral characteristics or human heuristics that we have that hurt us. So hurting, so that's a very easy one, right? If everybody's talking about the Magnificent Seven and Amazon and Apple and Google and AI, then we all want to get in on that. NVIDIA, don't you wish you had that or had it earlier? If you already do now, right? Everybody goes running for the, not necessarily in this case, the door, but for the bandwagon. But hurting can go the opposite way as well. Anchoring, you ever bought something that you invested in, say, you bought, Bitcoin at 30,000 and then it went down to 10, and you're just like, oh my God, this is horrible. What a bad mistake. Well, I can't sell it now. I lost all this money. So I'm just going to wait for it to go back up. And once it gets past 30, then I'll get rid of it. And so anchoring will put you in at a certain point. Okay. And it's hard for you to get off that point. So a good instance of that would be, if you bought something, let's say you bought a car at $30,000 and it has all these problems and you could sell it for $20,000, then would you? A lot of people would say, no, I'm not selling it. I already lost this much. I'm not going to buy a new one. But a good question to ask yourself when you're in a situation like that is, would you buy this car again for $20,000? You'd be like, no way. It's not worth that. It's not worth 10. If it's not worth $10,000 and you could sell it for 20,000, you should sell it for 20,000. But you were kind of anchored to that number before. Okay. That also is kind of where some cost fallacy will come from as well, too, is really thinking about where you are now not where you were before, and making that new decision to bounce off of. Loss aversion, people get hurt more when they lose money rather than when they make money. And it makes us make very suboptimal decisions for a lot of people on their investments and where they put their money and how they're going to grow it for different time periods. Attribution error is probably one of my favorite ones. It's not just for investing, but all of our decisions. If you understand this, you will become a better person over time. We tend to, and it's a good strategy for our mental health. When something good happens for us, we tend to say that's because we're awesome. We have good skills. We learned. When it's ever something bad happens, it's something external. It's because the economy did this, or because so-and-so at work caused this problem. It's not my fault. And so, obviously it makes you not be depressed, not want to hopefully even go to extremes and kill yourself. But on the flip side of things, we don't learn a lot of times from our mistakes, that a lot of times failures are our fault and we can learn from them and become better. And a lot of times when we're successful, it's because of luck, not because we're awesome. And if you can't see these things, then I think you should be able to tell really easy right now that you're not going to make the best decisions in the long term in your life. Okay. So those are just a few of the things that, we need to kind of understand when we DIY kind of self-invest, or we do anything in our lives, that we didn't evolve to do this well. This is not something that prehistoric man needed to do well to survive. Okay. So let's look at some real life scenarios. And I've been mentioning them as I've gone through those last couple slides. People tend to get a few high profile stocks and concentrate in them as well too, because especially after they've done well, it's very hard for them to get back out of them, because they're like, well, if I sell it now and then it goes up even more, then it's just like I was stupid, or I'll miss out on this, or it's done so good for me. And they tie some of their identity to it. I have a lot of people that have this problem with Apple, and getting that Apple sold out of their portfolios, even though they've won so big on it, is very difficult because it's tied up with some of their personal success and who they are, and they're that type of person. I see that a little bit with people that have ridden Tesla stock for a while, not just recently. But I see this a lot. If you try to get more sophisticated and swallow a little bit of humble pill and say, hey, listen, I'm not the best at picking all these individual stocks that I like, and I'm tired of jumping on the bandwagon. I would like to diversify some and get an ETF for a very good price that will diversify me, put me in lots of different stocks under a certain theme, or to be broadly diversified to invest in the whole stock market, or just large growth companies or small companies in the United States or international, whatever. You can buy these ETFs that they'll kind of do the work for you to get you that diversification and do the due diligence, etc. But that also tends to become random. People will pick funds that they looked at, like the 3, 5, and 10-year rate of return and how expensive the fund is, and they'll buy it. Or they saw something on Barron's or Wall Street Journal, or from some newsletter that they subscribe to, and they'll buy some of those, right? And from that, again, it's kind of like hodgepodging the stocks together, even though the ETFs is probably a little bit wiser to diversify more. It still ends up being kind of random as people accumulate that over time. And then, of course, your retirement plans, like your 401k, or if you're at a nonprofit, like your full 3B, or if you're at a smaller employer and you have a simple IRA, there's some funds inside of there. If you just signed up to get the employer match, you probably went into the default option, which is like some kind of target fund based on how old you are. You do just end up, with some fund that a lot of times people didn't even pick themselves. And then over time, people are not even holding the right amount of cash reserves or savings that you should have to kind of protect these investments to allow them to be long term. And so people tend to do one of two things. When they're younger, they tend to not have enough cash to where if an emergency comes up, which almost inevitably always happens, then they need to tap these things. And a lot of the times when that bad thing happens is not necessarily a good time for the markets, and they end up having to sell low. So even if you had good investments, Selling them at the wrong time can make you lose money, right? On the flip side of things, people that have had bad things happen to them are just naturally more conservative, or have been burned, tend to hold too much cash. And even if they have good stocks in there, but they're holding 30, 40, 50% in cash because they don't know when to get in, or they're afraid, or they see these investments they want to get into, but the market's so high, so they're just going to wait for it to go down again, which may not happen for a long time. Then this handicaps their rate of return, even though their stocks might have done well, but they're earning like 1 or 2% on their cash. Then yeah, maybe they would have made 12% per year, but when we averaged out, they made 5 or 6 when the cash drug them down. Because it wasn't invested. So we put these things together. I'm just showing you some of these real life scenarios or combinations of how these things can happen, that a lot of people are kind of that, what do they call it? Penny wise and pound foolish. They're like, I'm not paying somebody to help me. I can do all of this for, 0.1% going through Vanguard and handling my own DIY account. Very well, you absolutely could. Very few people actually do based on these things that we talked about. Then we look at kind of the opposite side of things. If you do get into where you have an advisor relationship with a firm, or hopefully a CFP advisor, so a certified financial planner that actually is a fiduciary to you, which means they have to look out for your interests before themselves, then especially if you're on the smaller side of things, they're going to build you portfolios that are built on models. And even though they might have the relationship with you, especially on the smaller side, tends to be shorter meetings online versus in person, because it's just a lot more efficient. You're going to end up with a portfolio of 6 to 12 either mutual funds or ETFs, which is going to, as I'm going to show you, put your eggs in different baskets a lot more efficiently and give you a high probability of doing well over the long term. Not knocking it out of the park, okay? We're not gambling here, but a higher probability of getting a good risk to reward. So depending on how much risk you're willing to take, the reward that is, as well as they can do, optimally efficient. So that in the long term, you have a high probability of accomplishing that, okay? And that's really kind of one of the things you learn if you're studying younger, or as you learn through hard knocks as you get older, is that the get rich slow is a whole lot better of a strategy for the vast majority of people than trying to continue to chase after the get rich fast, okay? And you have a high probability of accomplishing that if you make good tax decisions, good savings decisions, good protecting the things that you grow later on, rebalancing to adjust your risk to return over time. It's not necessarily sexy like calling Apple early or whatever the case and putting all your money in that. But if you think about all the tens of thousands of companies that were out there over the last 30 years, and how many of them had very low returns, and how many of them went bankrupt, if you would have put all your money in one of those instead of now hindsight looking back and knowing what the good thing was, you probably would have lost. Okay. And so again, it's a tough pill to swallow, but an advisor is going to help you understand this and build a portfolio that has a much better chance of actually succeeding over the long term, so that, again, you have a more closer to guaranteed chance of accomplishing the goals that you want, instead of a small probability that you become filthy rich. Okay. So this just, it gives you an example, a typical allocation, probably for somebody that's like moderately aggressive. So this is large companies right here, small and medium-sized companies. These two are international, kind of developed and emerging markets. Your bonds, which are more conservative, a cash allocation, or alternatives than a cash allocation. And you can kind of see this is about 30% conservative and about 70% in the markets, and the eggs are in different baskets. And this is very broad-based because you can have mega and large cap. You can have growth versus value. So growth is, paying extra for companies that you think, or the managers that you hire think will grow faster. Values more like what Warren Buffett does, to buy good companies, but to try to get them on sale. And you can have growth and value in every category. So you can see you can have lots of different what we call asset allocation, like sectors basically inside of here that this pie can get broken up in. And this is really what your advisor is going to do for you. You can try to do it yourself as well too. I very rarely find where people have done this well, DIY. And even if they did at one point where they took a spot, they didn't do that monitoring and something grew way better than one of these other ones in there and became way in that. And, 5 to 15 years later, this pie chart is way out of whack. Okay. It takes some TLC to keep it in the right mix. So what I'm going to do right now is I was just going to give you a little demo. So our clients, most of our clients, we manage money for them, as well as helping them with advice or financial planning or what so. And this is the backside of our investment management portal. So I'll actually show you the live side of it. And like I said, I can show you this. This is our pricing page on our website. This is actually one that's going up at the end of the week. I just did a lot of upgrades to it to add some of the new services we added. But you can see we have these freemium plans, which actually people could join us for free. I have Aaron throw up there where you can actually sign up if you'd like to. If you sign up for just our freemium, it's absolutely $0. You have our portal that helps you be able to add accounts and track spending and be able to have a repository for financial documents, do all of it. And there's lots of financial calculators and stuff inside of there that you can use for yourself. We're trying to build out. We haven't gotten it yet. It's a little bit harder in our industry just because of the liability and the regulatory oversight, but we're trying to build an AI to help people, again, for free. But we do have a freemium plus, and that's where this kind of comes to. If you're not ready to have a coach or an advisor, which we have to have minimum fee, not minimum accounts, but if I have to pay somebody to help take care of you, that's where the expense really comes a little bit more in. These are kind of advisor driven. The freemium plus lets you have investments with us, and you can use a lot of our strategies and what so. And it is $0, but you pay a percent of whatever account you want us to manage. And you can see what's included with all these different things. And I'm just going to get this out of the way just so you see it. If you're on our premium plus, like say you had $10,000 that we are managing for you and just an investment account or a Roth IRA, it's like $10 a year, right? It's 1% of 10,000. Okay. So it's like $100 a year, less than $10 a month. So it's very affordable for people, and it's kind of our get your foot in the door, kind of self-service yourself, use some of our awesome services, and then when it's affordable and you're ready, you can get a coach or advisor or partner to be there for you and help work things out. But this is our portal, and this is our demo account, kind of with our John and Jane Doe. And actually what we do is just take different accounts from different clients, change all the personal things about them, and mix them and match them in here. So this is actually a hodgepodge of actual accounts that we have of our clients. And you can see we keep all this data. We have over 10 different custodians you can use. So like TI Craft and Fidelity, and that one I mentioned, Altruist or Interactive Brokers or Schwab. And so people can have accounts at different places. We keep track of the rate of returns for them. We give you a portal so you can kind of see here where you have access to all this data as well. Even if you have accounts with multiple places with us, you see it all here. We have links to all the other different things you can go to, how you can see that we split your eggs up into different baskets inside of there. And then you have control of the data however you want. So like here, it's just showing you where your money's at. If it's at different places via us, you could pick an individual account to look at instead of all of them. You can change the time period almost any time. So most places will only let you see like quarter to date, or month to date, or year to date. And once you get to the end of the year, you get a whole year, but then they'll start over again because they don't really want you to see the long term of things, because especially if it's one that you're kind of self-directing, people tend to not do well. And if you let them see their rate of return stacked up over long periods of time, then again, kind of with that attribution error, they're not going to blame themselves for making bad investments. They're just going to blame Schwab. They're going to blame Fidelity. It's not my fault. They're crappy custodians, and, sometimes they can charge too much, and I'm not picking on these individually. That's just who's in here. But again, a lot of underperformance from investors is not necessarily the provider's fault. It is the individual's fault or the timing of how they're analyzing the data. So anyways, we try to give our clients good access to this, and then to help them understand how well they're doing versus a good benchmark that's kind of the red is like, hey, if I just invested in the S&P and the small company index and the international and the bond index in the same proportion of how I'm invested, how well did I do versus how the markets did, right? And how much money have I just grown when I add all my interest and dividends and capital gains up? So a lot of investment companies don't give you this stuff. And so I just wanted to give you a quick kind of sneak peek of that so that you could see, kind of our implementation of kind of that professional money management and giving that access as well to our clients. Again, you can ask questions as we go along. Got one now, try to hit real fast. It says, how could you know when it makes sense to sell a stock that has gone up a lot? That's a difficult question because, a lot of things that I will tell people, especially leading discussions like this, even like when I give presentations to other professionals at trade conferences and would say, there are a lot of different ways to win. There isn't just one way where some guru is going to write a book and that's the way to invest. There are lots of legitimate investment strategies. I'll say probably one of the wiser pieces of information when you're thinking about individual stocks, which I've read and kind of subscribed to myself, is when you invest in these individual stocks, if you're only going to pick a few and you're doing it kind of DIY like this, is you have to know why you got into a stock. What is a good price for what you believe about it? And what's a good price that you would get out of it? Okay, now not that can't ever change if why you got into it and what you think about the business evolves, right? You'll even see that with like Morningstar and other places that do rating and research and so you'll see their fair market value changes over time depending on how the business is changing. So even though Morningstar may say, that this tech company's worth this amount, 2 quarters later, it could go well above that. But because their earnings were so good and they did a good job, hopefully management-wise, the fair market value went up higher as well too. Now the fair market value can go down and the stock could be still going up as well. So you doing that personally have to understand why you own something, when you would be happy getting out of it, and you are able to reconsider that. But you should do it based on analysis of why you own it, not just how much money you've made or the momentum of how it's been going, or that you're being greedy or fearful. Okay. So again, that's not an exact answer to that question because it isn't that easy, because there's all these, like I had mentioned, like thousands and thousands of different stocks and companies that you could buy. And some of them are ascending and some of them are descending, and some of them are going to ride the wave of certain government subsidies or just how the economic wind is blowing right now. And so there's all these different permutations of how that could affect things differently. Okay. But yes, I definitely, for the individual stuff that I own personally, especially, and most of my money's invested like how I'm telling you here, but I do have some side accounts, and, and a lot of our clients will have small side accounts where you kind of do the thing where you want to invest in some things you believe in. I absolutely know when I want to sell most of those things, and I keep an eye on it. And you have to be willing to follow your own rules when you make them, and don't get greedy and don't get scared. Okay. So this is why we're going to tell you why don't the professionals most of the time make portfolios of individual stocks. And we're going to go through these, and most companies don't. There are some companies that have and do. I see that more at like some Merrill Lynch clients, Morgan Stanley, Fisher Investments, etc. Unfortunately, in my opinion, most of them are not diversified. They tend to very much concentrate in large companies in the United States, like bigger names, etc. And they end up being way light on like small companies in international emerging markets, and even the fixed income side of things. It seems more sophisticated, and it definitely seems sexier and more fun, but I don't know that necessarily that's better than the model portfolios. But when you look at the ones that are made very well with individual securities, especially stocks, They do tend to have still those eggs in different baskets, very well and balanced to have enough medium and small and value oriented and international from different countries and emerging market stocks from different countries, etc. But you need at least 100 different stocks inside of there. When we've done our own kind of internal research, somewhere between 200 to 300 to truly diversify, having at least like 20 or 30 in each asset allocation kind of bucket there. Okay. And if we just look at that from a practical purpose, in terms of most firms out there still make you buy whole shares, so not fractional shares of stocks, and then you need, just practically a certain minimum amount of money just to be able to buy the number of stocks that you need. And unfortunately, the stocks are not just all on average $20 a share, right? Some are $5 a share, some are $3,000 a share. And it's one of those things that generally, to really pick and allocate that money to the stocks that you want to, it's one of those things that you're kind of stuck with the higher side of stocks. So say the average, stock price then is like 300 or 500 or what so that you can actually get the right percent into the stocks and then be able to rebalance them or portions of a thing. Typically you need about $1 million to achieve that proper diversification if we're talking about the individual stocks and the bonds, et cetera. And not to mention the things that I was talking about earlier, which is what's the minimum economy of scale for a professional to even want to do this level of work for an individual. So $1 million, pretty much where you're going to be historically, and why you didn't see good stock portfolios being built smaller. If you were smaller, then it becomes more expensive just from the trading costs and what's so historically. And even if you are willing to do it as a professional and you can do it very efficiently, if these trading costs racked up to hurt your rate of return when your clients judged you, and maybe those trading costs knocked off 0.5% to 2% of your rate of return, then they're just going to think you're not good, right? So then not only are you trying to help somebody that's a smaller investor, they're going to be not appreciative and happy with you and probably fire you over it, right? Makes sense, right? Who wants to do all that hard work and then people be unhappy with your work, okay? And then you got to, like I said, take care of those positions over time as you rebalance, as they do good or bad, when you got to buy low and sell high. And then just operationally, instead of managing, 8 to 12 positions for each client account, you got to manage hundreds, right? And then if you're not watching them enough or something happens, you could get in trouble either by your client or by the SEC or by FINRA or by the state. And so in that respect, you just don't see this happen very often unless it's a decent size client. Still, even now, when I'm going to talk about, we can do this so much better, that you still don't see it very often. So transaction costs, manual processing, limited access of people that even have the expertise to do this and feel comfortable doing it on a larger scale for more accounts. And then if you're trying to DIY it, just information asymmetry. Up until 5 to 10 years ago, it was very difficult to just get the information you needed to try to DIY this, even if you were competent and educated enough to do it. Now the information's out there, but it's the same problem we're having, even with the internet and everything out there. Social media and everything is just poisoning everything. There's so much media stuff out there. People can lie about anything and nobody knows anything anymore. You can't figure out which information is right. And I think we're having that same problem in the investment side of things as well, too, that it is complex. Fractional shares have changed a lot of the operational side of just being able to build a portfolio for much smaller, because instead of having to buy one share at least of each one, and ideally you want more than one share so that, if you needed to take money off the table, you don't just got to get rid of it. We could sell, if we had 10 shares, we could sell 3 shares of it to harvest some of the gains, but still invest in it, right? And so now, if we have 1 share, we could sell 0.3 of the shares and still have 0.7, right? And so this allows us to have these precise percentages that we want to keep in each of these different companies, and to be able to buy and sell in more accurate ways. And so this allows us to get a portfolio that's, 200, 250 individual securities, with just 15,000 or so. So for us, the harder thing is, the more conservative you are, the higher the minimum. So 15,000, we've driven it down to 15,000 for like our moderate, and our aggressive investors, we can go as low as 5,000 on our Planck portfolios, because we have more of the money that's going towards the stocks versus the conservative stuff in there. So if we have to put 50% in conservative and 50% in aggressive, we're going to have higher minimums, because there's not as much money to be split up between the stocks. And then it allows us to not have lumpy portfolios, like I said, to where you'll have to watch out for the high price stocks inside of there, and you don't have the flexibility that you need. Okay. So this is a very important revolution. I still don't think even no fractional shares are a lot more widely available out there. I still think that most custodians are not doing this well in terms of getting the best trade execution for when you're buying or selling, and also passing on voting rights, securities lending, all kinds of different things inside of there that need to be refined. There are few, if any, custodians really doing this ideally. But we're getting there. It exists now, which is great. And so this is kind of the foundation of what we build our Planck portfolios off of. And the reason I know a lot of this stuff is because I have been chasing it and realizing what we could do with it to help more people get better portfolios, if we could do it well and find partners that would do it well. Another thing that's helping is automated onboarding and robo-advisors. So helping people to get their accounts open, transfers done, administrative things done without an expensive human having to do it. And so, like, as an advisory firm that wants to give that high touch, good service to our clients, the more we can take the expensive humans out of the equation, but still give you a very good experience, the lower the minimums or the fees we need to charge to be able to provide that to people. And so digital onboarding, figuring out more accurately like how aggressive or conservative you are as a person, and specifically on the account, because different account that you have, maybe your Roth IRA for the long term is aggressive, and maybe your college savings account for your sophomore in high school is more conservative because they're closer to needing to use that. And then being able to implement a lot of our trading and rebalancing without someone having to push a button to execute every trade for every individual account. It just takes too much. You wouldn't be able to do it as small of economy of scale. And then AI and our analytics tech and our trading tech is enabling us to be able to do, maybe 5 people's work with one person. So we still need the person inside of there for quality control and to give the right parameters, but it's really helping us bring down faster, better decisions, research, taking the data to where we can actually implement it. When you build these, instead of where a model, you can apply one model to 100 of your clients, almost every one of our clients is going to have an individualized built thing, which is pretty cool. And so this is kind of our difference personally, before I get into like telling you exactly how we're implementing the Planck. We're fee only and fiduciary. So we always, put our clients' interests before our own. We don't accept commissions. We don't have hidden fees. Our fees are kind of what I was showing you on here. You can see these are just our minimum monthly fees for these levels. Of course, if you do our premium plus, there is no minimum. Besides, you just have to hit the minimum for the investment strategy that you select. And you can see our fee schedules down here, whether you're a net worth client, because we'll help people with, their business and estate and taxes and, their retirement and as well as the investment stuff. And, we have like 5 different portals depending on if you're using our different services. But you can see the fee schedules. It is what it is. And then we produce monthly statements that show you exactly what it is instead of hiding it like a lot of the insurance companies and broker dealers and custodians and what so. And so multi-custodial. So again, we don't care who you use or want to keep your money with. We can keep it with Schwab. We can keep some with Altruist. Altruist is kind of our best one for the Planck that we're talking about right now, where they're doing fractional shares well, and we can trade it well, and we have the minimums very low. But we're driving that on 3 different custodians right now, which is Axos and Interactive Brokers and Altruist. Schwab and Fidelity don't provide fractional shares on the institutional side, and I don't even think they're doing it well on the retail side. So anyways, it's why we have multiple custodians, because we're trying to build these things to make things better for our clients. But still, Schwab is still a huge custodian with us because they do well at lots of other things. And of course, they're just a huge trusted name out there. And so if our clients need that, we provide it. We have lots of tech partners. We have our own tech startup that we started called Dervia. And so when we can't find it, we need it to make something better for our clients or for the RIA community in particular, then we'll try to build it. And then this is going to let us do, we personally like to do a lot of values-based things, whether it's ESG or it's religious-based, Christian or halal is Muslim faith-based, or impact investing. A lot of these things that I'm talking about here can be enhanced through the Planck. And so with the Planck, we're trying to democratize giving people awesome wealth management. So like, as I mentioned, if you're aggressive, with us for just $5,000, we can implement an individualized, stock portfolio, it has 150 to 250 different stocks inside of there, plus a little bit of bond ETF, just to balance out having a little bit of our eggs in a conservative basket. So again, this was previously only available to higher net worth clients. And it gives you a sophistication that's just rarely seen, under a few $100,000 portfolio. So we don't charge any extra for this besides the fees that I already showed you inside of there. And then we can do values-based things as well too. If you want to, invest socially conscious. And we have a cool questionnaire for that. And so I will show you, like, if you're looking through our website, it's just rebelfinancial.com, you can go to our investment management page and, scroll down through here. And we have where you can do a portfolio analysis. And down at the bottom, there's our impact persona and, kind of socially conscious. If you do the portfolio analysis, then you'll come to this page. And basically the way that it works, if you want us to break it down for you, is you'll just schedule a time that you actually have time to go over the results with Franco. He's our investment guy. He's not a sales guy. He's not even a financial advisor. He is our investment guy. Okay. He's not going to try to convince you to join our firm. He's really just going to give you a breakdown of how you're investing. So you pick a time. After you pick a time, it's going to kick you to here. You're going to upload a statement from the portfolio that you want it compared against. Okay. Or if you'd rather link via Plaid, if you click this, he'll have to send you a link to do it. And then you're going to click this and it's going to kick you over to a page to actually take our risk assessment, to figure out how aggressive or conservative you should be. And then we can break down how your portfolio actually is and then give you some feedback. So check that out if you want to. It's a cool offering, doesn't cost anything, helps us help people. And then where it aligns to where it's a win-win. If you'd like to hire us at one of those levels, then we'd be honored. And so you can kind of see here how we go through it. If you do some of that portfolio analysis, you're doing some of our discovery and onboarding already, so we can figure out how to build it for you. We build your portfolio, whether it's our traditional model, which is just trying to find the best investments for the lowest cost, regardless of any values based, or whether you're doing one of our values based, we'll build that for you individually. then we implement it. So if we have to open accounts, like we had mentioned at, Altruist or Schwab or wherever, we get all that opened and then transfer from wherever, or if you just connect it to your checking account, you can fund it. And then we ongoing continue to take care of it and manage it, et cetera. And then beyond that, we're building out more enhanced ways of helping our clients make a difference. Because when you buy these, we own them. We are the owners. And so the board of directors and the executive staff are responsible to us. But unfortunately, through most of the mutual fund companies and the ETFs, they're not really voting how we would want them to vote. They're mainly just voting whatever the board recommends most of the time, and also for only profit maximization. And for a lot of Americans, that's not exactly what they believe. We absolutely want to make money on what we invest in, right? But we also want to take care of our communities and take care of employees and take care of our country, do the things that we think are right. And we're not voting for these people to do these things. When we own the individual stocks like this, then we actually get to tell them what to do. And we're trying to drive that. And it is another awesome benefit of owning those stocks straight up versus going through the mutual funds or the ETFs. And so you can kind of see this minimum investments for mutual funds. Depends. Some of them are pretty elite. Some of them, as long as you put $25 in, you can get into it. Okay. So $25 to $10,000 per fund. You're going to need at least 6 to 10 mutual funds to diversify. With ETF portfolios, generally don't have minimums because you can buy kind of fractions of them. Some companies might have minimums for you to open an account or to not have a fee on the account or like a monthly or yearly fee. But probably about $10,000 for a diversified ETF portfolio. And then for us with our Planck portfolios, like owning all the different securities in there, somewhere between 5,000 to 15,000 when we're able to use the fractional shares. You don't really have any proxy voting rights with these. Sometimes when the funds themselves have management things come up, you'll vote on the fund, but that won't really pertain to the actual companies you own below them. And then with us, you have full voting rights. And so even when you open the application, you can say, I want to vote themselves, or I want Rebel to vote for me. Most of our clients, they let us do the voting for them because it's a real pain in the butt to get all these books in the mail. Most people throw them in the trash and don't do anything, which sucks again, because we should be telling these companies how we want them to run themselves to do better in whatever way you believe. Okay. Tax efficiency, mutual funds are probably the least tax efficient. ETFs were actually a good upgrade in this, but still kind of medium because you can only do it by category. And then when you own the individual securities, it's very high tax efficiency because there are a lot of different things we can do, especially this thing called tax loss harvesting, to be able to sell if something's down, then be able to buy it back 30 days later, recognize the loss, and we can offset it against gains and not a lot of times change the risk to reward or strategy of the portfolio. And then customization, limited versus extensive. So it's a really cool, good upgrade. Put a little high level example here, a couple here that's 45 and 38. They have about $345,000, between their 401k, couple IRAs, IRA, and a joint account together. And so previously they just had some mutual funds and a few popular stocks. They were paying about 1% in fund expenses. Plus, if they had an advisor fee is on top of that. After they switched to Planck Portfolios, now they own 245 different securities aligned with being moderate, and instead of maybe they were too aggressive before because it wasn't pegged down correctly. They reduced their fund expenses to near zero because the stocks don't have expenses. And they have professional management, and save for the taxable side of things, they were able to realize about $3,200 in losses, even though they made gains, and it helped them not have to pay as much like capital gain tax at the end of the year. And they were able to vote the proxies, per their beliefs to increase some diversity. Whether that's to at least have like one female on the board or what, so at 3 of the 245 companies. So they made a difference. It's not huge, but again, if we all could make little differences, it would add up to a lot, right? And so again, you can do that portfolio analysis. I kind of showed you through it. If you're watching this on the replay where the link doesn't actually come up, just scan that QR code, it should take you right there. And you can take it again. That's no cost. We do that to try to help people get aligned correctly. And again, we do it just because there's a few of you that will align with well to work to where it's, how Stephen Covey used to say, a win-win situation there. Check us out on our website. I don't like to hit this too much because I like to answer questions and whatsoever. We're a lot different than most of the other financial firms out there in the fact that, yes, we do the investment management, we do retirement planning. We also help our clients actually get their estate planning done, like their docs. And if they have a special needs child, we help our clients make sure that the banks aren't ripping them off with their cash management or charging too much interest on the debts that they do have. Tax planning, actually getting the taxes down by proactive strategies versus just the tax preparation. And yes, most of our clients, we do their taxes as well. And then if you have a business or maybe you want to start one in the future, we help our clients with the business planning, consulting, coaching, bookkeeping, payroll, setting up retirement plans and benefits. And so again, a lot more than most firms do. Beyond that, we're fee only and a fiduciary, like we talked about. A lot of these things I already talked about here. Very proud of these, but I mean, we are a tech company, but we still have the ability to dumb everything down and let someone do totally paper if they want to. We leverage the technology so that you don't necessarily have to, but you still get the benefits of it. And then we very much believe in our values. We're a B Corp, so we actually get certified in terms of taking care of all the other stakeholders besides just shareholders. So check out some of these things. Would love to be able to help you. Here's our team right now. You'll work with some or all of us, depending on your level of how you come up. So you can schedule a consultation if you would like to meet with a coach or advisor. These don't cost anything either for the first one, just to kind of explore. But again, if you'd like to just hire us just to manage a certain side portfolio, as long as it's $5,000, you can use that. You can use that freemium plus and experience that direct ownership. Take advantage of our Planck. I will open it up to questions. If there are any questions right now, I very much appreciate your time. If there are not, so let's see. Give it another minute or so. Otherwise, I may actually finish a webinar early. All right, let me check. All right, no extra questions. So again, Aaron put up the offers. Take advantage of the free consultation or the free portfolio analysis. Or hopefully this just helps you if you're a DIYer, just open up a little bit about how you may be able to do better for yourself. Check us out for some of our next webinars. We got a lot of good discussions coming up, and you can always sign up for just sign me up for all of them. So even if you can't make this, you could get the replay, or you just watch the replays of the ones that you're interested in. As I mentioned, ours are fairly unique because I make these every week. None of these are cookie cutter or going to be done again. That's why I do the on demand. So I try to keep them up to date with good content. Thanks for joining us today. Happy Wednesday, or whatever day you're watching this on demand. Hope to cross paths with you and to be able to help you in the future. Take care.